Netflix delivered a stellar Q4 with subscriber and revenue gains across all regions. Ads and gaming will fuel future growth, but tracking its evolving success will be much tougher. Listen on.
Welcome to this week's edition of Inside the Stream. This is Will Richmond from Video News, and that was Colin Dixon from In-Screen Media there at the beginning. Hey Colin, how is everything going for you?
It's going great, Will, and how are you bearing up under the freezing weather that's cast most of the United States into an Arctic blast?
Arctic is a good word to use. It has been cold, single digits here in the Boston area. Forecast to warm up a little bit over the next few days, but there is a real difference being outside between the temperature of 10 and 30. That's a bone-chilling gap that gets created there, and so it's not a whole lot of fun to be outside when it's that low. But hopefully it's. And of course, cold is one thing to complain about, but relatively speaking, it's nothing compared to the fires that the LA region has experienced, which has been so tragic, and also hurricanes elsewhere in the country and all the other natural disasters that we've seen. So cold is all relative.
I suppose so. I suppose it is. But I know LA is still struggling with those fires. There's another fast-moving one in North LA in the mountains. But hopefully they can get a handle on those real soon. Anyway, let's move on. We have some news items. We have a bigger news item to talk about. We're going to talk a little bit about Netflix and some of their numbers. We're going to look at the top line numbers, but we're going to look a little bit also where Netflix growth comes from going forward. But we have some news items, right?
Yeah, and I think you're getting us started with the first one, right?
I am, and one of the fallouts, I think, of the Venue Sports implosion, if you like, was Disney really giving pay TV providers options to launch smaller bundles of content. And that, I think, now seems to be playing out. We've seen Comcast this week has actually launched a sports and news TV bundle, which is targeted towards their broadband customers. And the price for this bundle is $70 a month, which is pretty expensive, I think. But you get 50 channels focused on sports and news. You get a cloud DVR with, I think, 300 hours of storage and a subscription to Peacock Premium, which is Peacock's entry level. Remember, that still has ads. So that's what you get. What's included in the channels? You get your locals, ABC, CBS, Fox, NBC, Telemundo, Univision. You get all of the primary cable news channels. So there's 4 of them. You get sports networks, including ESPN and FS and Fox Sports. And as I say, you get this cloud DVR and Peacock Premium. So I should mention also, you get 100 free fast channels powered by Xumo also as part of this bundle. So it's an interesting bundle. I'm not quite sure it's well targeted, Will. If you are a news hound, this is very expensive to get the news. You can probably get the news more cheaply than this bundle, particularly. I mean, I doubt that there's many people who want to watch Fox News, CNN, and MSNBC and CNBC. So there's probably cheaper options to get the news. Sports, it's an interesting bundle, and Peacock is carrying a lot of sports, so that might be more interesting to sports providers, although I still wonder if the price is a little high. I wonder if you would be better off subscribing, say, to Sling TV and to Peacock separately. I think that might well end up totaling less than $70, and you'd also have a lot more freedom. You'd have the DVR as well, so that might be a better deal. So I question its value. It's certainly not very valuable to people who don't have broadband. You can subscribe to it if you want to, but it's going to cost you $90. So $70. What do you think? Is this interesting to you? Would you be interested in this?
Well, I guess the benchmark for me, or the comparison, is YouTube TV, which of course just had the price increase from 72 to 83, I think. Is that the right number now, Colin?
Yes,
83?
yes.
Yeah. So for 83, $13 more a month than this $70 package from Comcast. It's probably worth having, all the channels that come with YouTube TV. Although personally I don't watch many of them, but just from a, if you're kind of a, group of 4 or 5 people in a home, having that diversity of channels is probably worth the extra $13. I still think it's a smart, good move by Comcast to do this, to have this type of an offering out there to, remain accessible for people who are either cutting the cord or have cut the cord. It's an offer that broadband subscribers can feel is a benefit to them, if you will, the $20 discount. And from a sports standpoint, it has most of the big sports networks, national sports networks in there. It wasn't really clear to me how the regional sports networks fit in. I don't see them listed here, but maybe they're included or going to be included as well. I'm not sure. So, yeah, I think I'm with you. I don't think that it's a, gangbusters offer, but I think it's a respectable offer and a worthwhile offer.
Yep. And we are continuing to see bundles as a factor in the market, right?
Yeah, we talked about this last week, and then this week we see another new bundle of Max and Stars being offered on Prime Video. They're offering that for $21 a month. That's a $7 discount from the standalone, what those standalones would be: 17 for Max, 11 for Stars, 28 a month. So they're offering a discounted bundle there. We just talked about this actually last week with Vizio, because Vizio introduced a discounted bundle of Stars with AMC Plus. So there's Stars popping up 2 weeks in a row as part of a bundle. But we remarked on this last week because the bundling of streaming services we've seen in the mobile world, we haven't really seen it as much provided by the kind of OEMs or platform services like an Amazon. So now we've seen it this week, and I would say from my perspective we're going to see more of it, because the streaming services certainly recognize that discounts help offset churn, and churn is a big factor in the industry, continues to be. And for services like Prime, it creates more value for their members to be able to present these types of offers, same for Vizio. So I think we're going to see more of this going forward. How about you?
Totally agree. I think it's great for streamers to have that option. It gives them a way to save money if they're interested in those particular services. And I think one of the things I like about this is it gets people off the fence who might have been on the fence for another service to take it. I can tell you it's working for me right now, because I'm in the Disney Duo bundle of Hulu and Disney Plus. And there is no way I would have subscribed to Disney Plus on its own, but there is a chance that, there's going to be 1 or 2 things in the year that I'm going to want to watch. And the difference in the bundle price is so small versus just Hulu on its own that it seems worth it to me. So I think that sort of decision making that gets people off the fence and subscribing to a bundle is probably good, a good flexibility and a good option for subscribers too. So yes, I think we are going to see a lot more of this year, a lot more different types of bundle from a lot of different types of providers. So we'll probably see more bundles coming to us from our telecommunications companies going forward, which also offers the ease of paying, because it's all on one bill, or on another bill at least.
Yeah. Well, one company that does not seem to need a bundle strategy is Netflix, which reported its Q4 results this week. And talk about blockbuster, boy, quite a quarter for them, quite a year. So you're going to get us started with that review.
As you say, what a quarter they had. They added 18.9 million subscribers globally to take them to wait for it, 301.6 million subscribers, which I think is, if you told me 10 years ago that Netflix would have 300 million subscribers, I may not have believed you, even though I was quite bullish on the service. So I think that is pretty darn remarkable that they've added basically 19 million subscribers in one quarter. Of course, the fourth quarter is always a good quarter for them, but nothing like this before. And really, Will, this has been across the board. You've seen gains in all of the 4 regions that Netflix provides information on. Even in the very mature market of the USA and Canada, even there, Netflix was able to add 4.8 million subscribers to 89.6 million. EMEA is now the biggest region. They added 5 million to get to 101.1 million. And LATAM and APAC also put on pretty good growth as well. We saw tremendous growth in revenue. The company now is a $39 billion company, increasing revenue by about 16% over 2023 in 2024. And the only black mark I can find in their report card for this quarter, Will, is when we look at ARPU, average revenue per unit. And there were good gains in ARPU in all regions except LATAM. Latin America continues to be a challenging region. There's a 7% decline in ARPU year over year in LATAM. It's now fallen to $8. And, they did mention that there were still some currency challenges. The dollar is very strong right now. But I'm looking at APAC, and APAC was basically flat. EMEA was increasing. ARPU was up to 3.3%. So that excuse really doesn't wash with Latin America. So there's something else going on there. But that's the only black mark. Everything else is all up and to the right.
Yeah, I totally agree, Colin. And your breakdown of those regional numbers also, just to add a little bit, the big one was really, well, I should say all the regions year over year, except EMEA, reported really sizable additions in subscribers. The UCAN region a year ago was up 2.8. This year it was up 4.8. LATAM a year ago was up 2.35. This quarter was up 4.15. APAC last year was up 2.91. This year it's up 2024 it was up 4.94. So 3 of the 4 regions reported really strong increases. The only one that was really essentially flat, just down a smidge, was EMEA, which was at basically flat at adding 5 million in the quarter. And as you said, is now the largest region in the world, 101 million subscribers, up from 89 million a year ago. Remains bigger than UCAN. It's been bigger than UCAN for a while now. So yeah, I mean, really just strong across the board. And as far as, what accounted for the growth, they were really kind of pointing to, or rather not pointing, I should say, to any one specific content event. They certainly pointed out that the NFL games performed very strongly for them on Christmas Day, as did the Jake Paul-Mike Tyson fight, performed well from an audience standpoint. But overall, the quote that they provided in the letter was, and I'm reading now from the shareholder letter, Q4 membership growth was driven by broad strength across our content slate, improved product market fit across all regions, and typical Q4 seasonality. So really not zeroing in on any one thing, although I think, as you and I have talked about before, the password sharing crackdown has, in the past, and probably in this quarter as well, really contributed to starting new subscriptions. And it's not clear that crackdown has really happened everywhere in the world yet, or across, all subscribers within a region, but for sure it's had an impact in the past, and almost certainly had an impact this quarter as well. Although Q4 traditionally, as I say, Q4 is a very strong quarter for them. So it always has been, and this quarter performed even better.
It did, Will, and just to sort of fill in some details, there was a lot of chatter about this in the earnings call on Wednesday, and a lot of chatter about this. And basically what they said, that the Greg Peters, who's one of the co-CEOs, he was asked about this, and he just said, he was asked, was there an impact from the NFL games? And he just said no. What he actually said, well, first of all, the Mike Tyson fight attracted an audience of 108 million globally, and the two Christmas Day NFL games attracted an average audience of about 26.5 million. So they were very, very big events. He pointed to those two and the release of Squid Games Season 2. And he had this to say. He said, our estimates for subscriber ads driven by those titles combined represented a small minority of our total member acquisition for the quarter. So I think you're absolutely right, Will. I think that we are continuing to see the benefit of password sharing curbs, and the fact that they're continuing to do extremely well with viewers. And in fact, Ted Sarandos he's the other co-CEO of the company. He reinforced this. He said the retention behavior of those folks, and he's talking about the people who joined for sports, of those folks that did come in for those events, looks a lot like all the other folks that come in for other titles. And so, I think that is something that the company is continuing to do extremely well. And in fact, there was some really interesting data from Luminate, which kind of highlighted this. They were talking about content creation generally in the US, and they gave the top 10 US streaming series for 2024 and the top 10 US streaming movies for 2024. And boy, does this tell a tale, Will. Basically, Netflix owns the top 10 list for US streaming series. 7 of the top 10 shows are Netflix shows. And in the top 10 US streaming movies, once again, Netflix is well represented. I see 4.5 movies are Netflix movies. One of them is shared between Netflix and Peacock. That's the Super Mario Brothers movie. And Disney has 4. It has to admit that is an area where they're very, very strong. But that really tells the tale of, I think, why Netflix continues to do extremely well. So yeah, some people came in for the sports, but they sure stuck around to watch Carry On, to watch The Equalizer 3 or Super Mario Brothers or something like that. So there was plenty of stuff for them to stick around and watch.
Yeah, and that Luminate report also noted the decline overall in the production of episodic programming. Said it was down 8% in 2024 versus 2023, down from 414 titles to 380, and Netflix really dominated there. Let's see, 146, if I'm reading this right, 146 out of the 380 were Netflix shows, and Prime was next, although it declined from 42 to 39. Peacock jumped from 25 to 36. But the big one that declined was Disney Plus. Disney Plus titles dropped from 25 in 2023 to just 9 in 2024. Now, again, Disney Plus just said it had strong subscriber gains, so I don't know if that reduction in production is really affecting them yet, but we'll have to keep an eye on that as we go forward. But, just stepping back, we think about the Q4, the strength of the Q4 report from Netflix. They have the financial muscle to really outproduce everybody else. And combined with the content that they license, creates a really powerful offering for viewers, and that certainly is translating into the subscriber numbers, right?
Isn't it just? And that reduction in production of titles released through Disney Plus is so shocking. 25-9. It really seems like Disney's really switched strategy a lot, and it's got me wondering why I continue to subscribe even to the Disney Duo. But I guess that's another topic for another day. I guess we'll wait for when Disney reports their numbers. But there were a couple of things I wanted to highlight here, Will, and I'm really thinking forward here. How is Netflix going to continue to grow? Perhaps there are two areas, I think, where they're really focused, where I think we're going to continue to see growth come from. I think, okay, so they have a great quarter of subscriber growth, but we know that they can only continue to do that for so long in the US. It's a very saturated market. They're the most deeply penetrated company now with about 89.6 million subscribers in the United States and Canada. That probably means there's about 80 million of those are in the US. That's incredibly deeply penetrated. So they'll be having a lot of difficulty growing further there. So I think there are two areas that I think really are potential growth opportunities for Netflix. So the first is advertising. And they talked a lot, Greg Peters talked a lot about how they are moving from the crawl phase to the walk phase. They always like to talk about the fact that they've got this crawl, walk, run approach to markets where they sort of get in and crawl, and then they get to the walk phase, and then they really take off. He says that they're entering the walk phase for advertising for them. He says about 55% of signups are on the ad plan in markets with one. And he also said that they don't really see any difference between engagement between people that are seeing ads and people that are not seeing ads. And engagement, they say, on average per member is around 2 hours a day, which is a pretty phenomenal number when you think about it. 2 hours a day for those 80 million subscribers, or those 300 million, I guess. And what he said was that he thinks the company now has reached its scale goals. And he was talking about scale to provide to advertisers a decent audience for them to think it's valuable for them to advertise against. Their main growth driver, I think, will come because they're now beginning to roll out their own ad tech stack. And basically what he says that will do is it gives them a lot more control now, and that they will be able to offer a lot more flexibility back to advertisers, allowing them new ways to buy, and basically making it what he says as fewer activation hurdles for advertisers. And over time, the ad tech stack will allow them to offer programmatic availability, enhanced targeting, better reporting, and a whole bunch of other features that they're really looking to develop to boost advertising. So I think that's one of the big areas that they're looking for growth. And that's a much more short term. That's something that's happening right now. They're trialing the ad stack in Canada today. And that is going to start rolling out in the US and in other markets in April. So I'll pause there before I go on to the second, because I know ads is one area that you're particularly focused on.
Yeah, absolutely. I mean, we've talked about this many times in the past, that Netflix was kind of a late comer to offering an ad-supported tier. They had said for a long while that they really wanted to offer an ad-free experience to their viewers, but then they introduced it kind of simultaneous with the crackdown on password sharing to really offer a low-priced way of getting those viewers who may have been getting shut out by not being able to use a shared password. And it's worked really well for them. And as you said, 55% of signups in the quarter. It's still early days for them, but they're certainly getting scale. As they pointed out, I think they mentioned that they're going to feel like they're going to get to scale in their various markets in 2025. So that's been a huge win. Really cannot be underestimated, I don't think, the impact of the lower priced ad-supported tier that Netflix introduced.
Yeah, you bet. So I think that's going to be one of the big drivers for them, Will. The other area that I think is going to be a big driver is for games. And Greg Peters really gave quite a lot of details about how they're thinking about games going forward. He said that he's particularly pleased with how games based on Netflix IP, Netflix shows and movies are doing. And what he said there was that they're really just scratching the surface of what they think that they can do. And I think he's probably right, and I'll get on to why I think that in just a second. But he really pointed to 4 areas of games where the company is pushing forward. He said they want to do more narrative games based on Netflix IP. He said that they are moving into a new area, which he called party and couch clock games on the TV. And this is really, he sees this as an evolution of the family game night where people would gather around a board. Now they're going to gather around a screen, and play games on Netflix. He also sort of suggested that this was sort of an evolution of the game show, of the TV game show. So that's the second area. The third area was, he said, kids games. They're doing very well in that area. The kids games, they don't have any ads, they don't have any in-app payments. So they're a secure place where parents can allow their kids to play without worrying about anything they're going to see or if they're going to start charging stuff. And the fourth area is an interesting growth area for them, and that's in mainstream game titles. They had fantastic success when they released Grand Theft Auto. He said that was the best performing game they've had on the service. And they're planning on licensing more of those and driving that. And I really think that this is, for Netflix, it's a long-term play that in the long term, I think is going to pay off pretty darn well for them. I was watching a short podcast by John Geigengach of Hub Entertainment Research, and we've had John on the show. Maybe we should have him back. And he was talking about how well games do with younger people. And I tell you, Will, it was very eye-opening, the data that he was providing. I'll certainly provide a link to that podcast in my posting. So if you want to watch that, I highly recommend it. It's very interesting. But basically, for young people, games is where they spend the most time. Games are far more than just live playing. It's also where they chat. They chat about other things other than the games in this environment. They and they play together and they watch together. And so these are really social entertainment platforms. And they spend far more time doing this than they spend watching regular TV. And I think that's really telling. And I think that really tells the story of why this investment in games by Netflix is a really super smart move and is a great investment for the future of the company.
Yeah, I agree with you. You're closer to this than I am, but certainly we all are aware of how popular games and gaming has become. And Netflix, I think, really found an opening there for themselves in enhancing the service with the availability of games. So, and now it sounds like they're going to kind of invest even further in that area. That can only help reduce churn even further, especially for newer subscribers that are still finding their way around the service.
Yeah. And so there's only one other thing I want to mention. Well, I think we should mention, and that is that this is the last time we're really going to be able to talk about subscribers in any meaningful way and to Netflix. And that's because they made the announcement last year that starting in Q1 2025 that they would no longer report on paid subscribers. And that, I think, is a great loss. It's a great loss to you if you are a Netflix stock owner. I may be in some of my mutual funds, but I'm definitely not an individual. I don't buy stocks of companies that I talk about, just by policy. And it's a great loss, I think, to us, not least of which we lose the ARPU numbers. We can't, if we can't know how many people are subscribed, then you can't calculate the ARPU numbers, and they're not going to give those either. And I think this is really important. This is really important information for us to be able to evaluate the health of the company. And I'll give you a super example. They're bringing in a quite steep price increase and in fact, it's already effective. They're actually increasing prices across the board. So they've increased the standard with ads tier by $1 to $7.99. The standard plan with no ads has gone up $2.50 to $17.99, and the premium is going up $2 to $24.99. And they didn't give us a price increase last year, but that's because they were rolling out these password sharing curbs, and they thought the two would be too much for the market to bear, which I think they're absolutely right to have done. But here's the thing. We don't get to see now how this really has impacted the company. The only way you can assess it is if we see a revenue fall. And that's really not a great measure. We also can't see how successful they're truly being with the advertising, because we can't see ARPU changes in subscribers. That's one of the main ways you can tell if the advertising strategy that they have in place is being successful. So this is a great loss. I personally will be focusing a lot more on the engagement data that they're going to be providing. They say they're going to beef that up. They're going to be providing that on a quarterly basis rather than half yearly basis. So I will be buried in those numbers and analyzing those numbers to look for trends. But, this is a great loss to us. I don't know. It's going to make it a lot more difficult for us to talk about Netflix in our podcast, Will.
Yeah, it's kind of an end of an era to not be able to talk about Netflix subscriber additions also. We've been doing it for so long.
We have since the very beginning. And I'm really disappointed to see them do this. Pay TV operators, they always report on their subscriber numbers, and they report on those subscriber numbers because they are so important to investors to see how their business is doing. And I'm just surprised that they've done this and disappointed.
Yeah, well, it is what it is going forward, though, Colin, and certainly if they continue to report the type of revenue increase and profitability increase that they did in Q4, it'll probably be overlooked, right?
I'm sure it will all be forgotten very quickly if that's the case, Will. And, looking at these numbers and looking at their position in the market, boy, they are really powerful. The only company that can really challenge them right now is YouTube.
Yeah.
And YouTube, of course, has a very, very different business model.
Yeah. Well, let's leave it at that for today, Colin. Good rundown of what happened with Netflix this quarter. And, as you just said, and I agree with you very much, they are a force to be reckoned with. You've got to give them huge credit for how they've navigated the market for so many years, capping with this Q4 report here. So I think we'll leave it at that for today, right?
Yes, you bet.
Okay, Colin, good chatting. Thanks everybody for listening in, and we will see you all again next week on Inside the Street. Inside the Stream is a production of In-Screen Media and Video News, all rights reserved.